welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest Bill Ghauri today. Before we get started, a short disclaimer, Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. We believe hypothetical computer simulated trades are accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And you can read this in its entirety at the bottom of any of our web pages. So while we're transferring the ball, welcome, Bill. I've known Bill for a long time. We were back in the day with the Sheridan community. Actually, before I was even working for Dan Sheridan, we were exchanging ideas, and you actually sent me, I think it was a spreadsheet that I used to build that original price movement analysis. I think they called it the storm meter, and that was inspired by you. So we go back a long way. So it's nice to have you here and to be in touch again.
All right. Well, thanks, Tom. I think I got the wrong screen again, so hold on. Let me do this again.
We're looking at your thanks for using WebEx screen.
Okay. I want this one here. Okay. So now you should see, I think, the screen for the presentation. Okay,
right
good.
One.
Okay, good. All right. Well, thanks for inviting me to do this presentation, Tom. And yes, we have known each other for a while. I mean, back in the Sheridan days when we first got started. But any event, what I'm going to do today is I have a slide presentation that's about 20 slides. There's quite a bit of material. So what I'd like to do is have people hold off on questions until I get through the slides. And by the way, the slides will be available for download after the presentation, along with I'm going to have some trade logs and some charts and things like that that will also be part of the materials that can be downloaded. So I don't think people really need to take notes. Just kind of sit back, take the information in. But like I said, the slides are about 20 slides long, and then we could kind of break it for a little bit of discussion. I'm hoping to get through the slides in about 15 minutes, and then what I'd like to do is do the live demo, because in the live demo I can show things that I can't put on a slide, and that's where I think we can really get into some interesting stuff. So any event, let's move on here. I got to put a little disclaimer here. Everyone knows that you can lose money trading options if you don't know what you're doing, and past performance is no guarantee of the future. And this is my experience. Other people may have different experiences, so I'm just basically giving you my experience of what I've done. So the presentation today, I'm going to talk about three basic concepts, just a little bit about my background, trading background, and the model development. Then we'll get into the meat of the presentation, which is the risk and money management principles. I'm going to touch a bit on portfolio metrics. These are the yardsticks that that you use to really measure how well a strategy is doing. Then I'm going to talk about the model definitions that I use, and I'll present the results of a very, very simple strategy, and then we'll go into doing a live demo. So with that said, the three concepts are this. I can't stress enough that you've got to have a comprehensive plan for trading. I mean, we've all heard that: plan the trade, trade the plan. I mean, it can't be more true that you need to look at how you trade in terms of the strategy and the risk and the money management as kind of a holistic system, because when you do, you'll find that you'll get much better results with less risk. The second item is that to me, you really need to have a good reason to enter a trade. To enter a trade, to put on a XYZ butterfly at 45 days to expiration, and that's your only reason, that's not really a good enough reason. You got to have an edge. So in the sample strategy that I'll demonstrate, you'll see that it doesn't take much in the way of technical analysis to give you some edge, and when you combine that with risk and money management principles, you can actually do pretty well. So when you start doing that, also you might find yourself becoming a directional or more of a directional trader. And then the third thing is that, in my opinion, you really have to automate the process, because you can't really create, test, verify these trading strategies and the risk money management plans and how they perform and how you can tweak them without having an automated system to do this. I just don't think it's possible with backtesting. So, like most people, I did other things before getting into options. As Tom said, we were together, I think it was the same year, around 2006, that we were both students of Sheridan Option Mentoring. A couple of years after that, I really kind of started trading full-time. Today, I manage multiple PM accounts. So how this model came about is that I realized that I had to automate in order to get to a higher level of analysis. So what I did is I purchased some end-of-day option data from myvolatility.com. There's many vendors out there. That's just one I happen to use. About a year ago, I built a backtesting model in Python, and that was primarily to test some ideas that I had, and it was fruitful. But then I guess it was about maybe Thanksgiving or so, I decided to rewrite the model. I bought some more data. This time I built it using SQL Server and Excel VBA. But it doesn't matter what you build your model in. That's not really the point. But the amazing thing to me is that after I built the model is when I really discovered the true value of risk and money management. It really started to become a lot more clear when I started running the model and running different scenarios. So the meat of the presentation is this: it's the risk and money management principles that you should apply to your trading strategies. The first, and I'll go through each one of these in details, but these are basically the fractional risk, portfolio running risk, trade price risk, how you size a position based on risk. Another thing I call maximum positions per expiration. I want to talk a little bit about risk-reward ratios, and then you'll see how all these principles come together to form your overall risk and money management plan. So the first one is fractional risk, and what this is basically how much of your portfolio do you want to expose to the risk of any one bet or any one trade. Typically, you'll see values of around 1 to 3%. I myself normally don't use more than 2%, but it'll vary depending on the strategy you're trading, what kind of win rates you get with that, and your own appetite for risk that you might have. The next concept is what I call portfolio running risk. And this is how much of your total portfolio balance or allocated capital do you want to be exposed to the market in any given time. And the reason why you want to limit the amount of exposure you have of your portfolio to the market is because you're going to most often have multiple open trades. So this is just another measure of limiting the risk to your portfolio. Sometimes the fractional risk will be the determining factor in terms of how you size your positions. Sometimes it'll be portfolio running risk. But typically you'll see values about 50 to 75%. The next item is what I call price risk. And this really applies primarily to selling options, not so much on buying options, but selling options, which is what most of us do. We're premium sellers. That's what we do. So what I do is I define the price risk at the start of the trade. And the way I do that is I have a stop multiple that I use to define the price risk. And typical stop multiples that I use are around anywhere from about 1.2 to about 2.0. I seldom go over 2.0, but somewhere in that range is usually pretty good. Now, it's also a function of the risk-reward ratio that you achieve. You'll see this a little later on, but I'll give you some very simple example of how you would calculate price risk. As an example, let's say you're selling a put and it's $2 and you have a stop multiple of 2. Well, that means your stop price is going to be $4. $2 times 2 is 4. Now, your entry price is $2, so your risk on that is $2. $4 minus $2 equals $2. So that's the risk that you have, the price risk. If you were using a multiple of 1.5, you would your stop price would then be $3 less the $2 that you sold it for. So therefore, you'd only have $1 of price risk. So your stop multiple will determine your stop multiple along with your entry price will determine your price risk. And so how is this used? Is that you use it to size your trade. So you take the fractional risk that you're using, if it's say 2%, and that will define how much equity is available to size a trade. You use your price risk and the appropriate contract multiplier, which for most of us, most of the stuff that we trade is 100, and you can calculate the position size. So it's basically the portfolio balance times the fractional risk divided by the price risk times the contract multiplier. So if you had $100,000 portfolio balance and you were using a 2% fractional risk, that would be $2,000 divided by, let's say the price risk is $2 and the contract multiplier is 100, so that'd be divided by 200 and you'd get 10 contracts. Now the nice thing about this method is that it automatically scales for price and stop multiples. So as the stop multiple goes up, the number of contracts that you're going to trade goes down. So what it does is it keeps the risk to your portfolio constant for every trade, and that's key. That's a very key principle. Another thing that I use is I limit the number of positions that I have that have the same expiration date. The reason why I do this is because you can have some positions. Well, of course, it depends on the strategy that you're trading and whether it's what I would call a long strategy or a short strategy. But if you have a concentration in the same expiration and there's a downturn in the market, for example, these are long type positions, then you can get hammered and you'll have several losses, consecutive losses. And if you have, if you're trading 3, 4, 5 positions with the same expiration, then you'll see these a number of losses, consecutive losses. So it's one way of thinking about this is that by limiting it, then you kind of are adding in an element here of forced time diversification. Weeklies are helpful. Weeklies, quarterlies, they're helpful, but in the case of weeklies, I've seen a problem with low open interest, but it depends on where your strike placement is and how far the days to expiration. So that, because for a lot of the stuff that I'm doing, it's far enough out in terms of days to expiration that a lot of times weeklies don't get considered, also for a number of other reasons, open interest being one of them. But the risk-reward ratios that you will get for when you sell options, generally speaking, they don't have a great risk-reward ratio. Of course, the profit target multiple that you set, the stop multiple you select, those impact your position size, your risk-reward ratios that you achieve and win rates. So it's by nature, selling options, you have to be, I think, a bit more disciplined because the risk-reward ratios that you might achieve are, well, I'll give you an example. If you had an entry price of say $2, again, you sold a put for $2 and you had a stop multiple of 1.5, your price risk is $1. But if you say my profit target multiple is going to be 0.8, then that means that the best you're going to be able to do from a risk reward standpoint for that trade, the very best you'll be able to do is 1.6. That's okay. I mean, I like to see things above 1, but compared to basically a long short type system, you'd never trade something with such a low risk reward ratio. And you'll see when I do the demo in the trade logs, you'll see the risk reward ratios that come up, and so we'll get into that a little bit more. The portfolio metrics that I use to basically measure the performance of a system is the win-loss rates, the maximum win, maximum loss, average win, average loss, profit factor, which is basically gross wins divided by gross losses, the expected reward, expectancy, that's the mathematical expectancy, which always has to be positive. I mean, otherwise you're going to be losing money. The risk-reward multiples that I've planned for the trade, as well as what I actually achieve, are very key to me. Of course, the return on capital, the annualized return, and then I also look at Sortino ratio, which is just, it's like the Sharpe ratio, but it just measures downside deviation. So as I've said before here, the ratios for selling premium or an options, for an options trading system are different than a system that's just where you're basically long or short. So the metrics that I like to see is I like to see win rates greater than 60%, although that's not a must. I can show you some systems that are under 50% and do fantastic. Profit factor, it's nice to see them up around 2.5 or better. Positive expectancy is a must, a 0.3 or better, but the higher the better. Risk reward, you'd like to see it over 1. Return on capital, certainly better than the buy and hold of the underlying, and same with the Sortino ratio. You want to have that higher than the buy or hold of the underlying, because after all, if you're going to do a managed account, you've got to beat the market with less risk, or what's the point? Let me just touch briefly on the model definitions that I use. I refer to a strategy as just a general description of what it is that you're buying, selling in terms of calls and put combinations. The one I'm going to show is just basically naked put selling. The market is basically the symbol that you're trading. SPX, RUT, SPY. I mean, these are all the very popular indexes that most of us trade. But then I have a method of applying technical analysis, and I call these systems. And these systems are actually a subset of the market traded. And what a system is, it's a collection of trade signals, which I'm using basically daily data. So it's the dates that say, hey, this is a valid trade that you can take, and it's based on technical analysis for that particular market. Now, I can generate multiple systems. There's really no limit to the number of systems that I can create and test for each market. Now, another thing that I do is I generate 2 systems for each market. I generate the underlying system and a volatility system, and I call this the underlying volatility system pair, or UV pair. And this is just my own terminology. I mean, it's, but obviously SPX and VIX is a UV pair. The SPY and the VIX is a UV pair. The Russell, the RVX is a UV pair. NDX Vixen is a UV pair. So you'll see when I do the demo how I use these UV pairs and the technical analysis applied to each in order to do my back test. The trade parameters, when I refer to trade parameters, I'm just talking about the model settings that pertain to each trade, such as the DTE window that I'm looking at, the strike placement, the stop multiple, the profit target multiple. Money management parameters apply to the entire backtest run, and this is really the fractional risk, the portfolio running risk, and maximum trades per expiration. So, with that, what I'm going to show in the live demo here is this is a super simple directional SPY put selling strategy, and it's based on the underlying system, the SPY. It has to be above its 200-day SMA, and the VIX has to be 10% move up from the previous day, or a vol pop. So if these two conditions are met, then that becomes a valid trade date. I'm looking at a DTE window of 35 to 60 days. I'm placing the strikes 5% out of the money. I require 5,000 minimum interest for the open interest for the strike, and the reason I do that is because I want to filter out strikes that have a wide bid-ask spread, because everything is based on mid-price that I'm using. So that I find is a very good filter. I'm using a 2% fractional risk, a stop multiple of 2, which is actually high, a profit target multiple of 0.8, and I'm limiting it to 1 position per expiration. I did the back test from beginning of January 2008 to end of October 2014. I have data actually going to the end of the end of December, but I stop it at October so that if there's a trade that's actually taken in October, there's data there for it to actually run. So with that very simple parameters or system signals, the equity curve looks pretty decent. And you could the green line is the option strategy. The red line is the SPY buy and hold. So the way I ran this test, I said you start on that date with 100,000. In the case of the SPY, you bought whatever the number of shares that you could purchase on that beginning of the start date of the back test, and it's a buy and hold. So obviously there's no compounding. Now there is dividends, but that's not shown here, but that's going to be kind of minor. So you can see the flat line in the green option strategy. The reason why it didn't take any trades is because the SPY was below its 200-day moving average. Then you can see, I don't know if you can see my cursor, but
yeah, we can see it.
Okay, so starting here, it took the first trade because the SPY was above its 200-day moving average. So it started taking trades, but then we had another flat spot, and that's because it was below the 200, but then it resumed again, and then we had another period where it was below the 200, and then it just kept on going. So you can see how just this very simple strategy limited the risk and actually did better than the buy and hold. Now this again is what I would say is very conservative settings. So and the demo you'll get to see how let me just say this equity curve is not optimized at all. So I think it's ready. It's probably time to do the demo. But if Tom, you want to do some take some questions, we can take some brief questions, or I can venture on. I'll leave it up to you.
Yeah, there was only one question. Was your backtest data done for just the bull market? What about backtest for bear market?
I can do for essentially any. I can test any system. This one that I'm showing here is a long system, but I've done dozens of systems, and so once you have the option data, you can test it for whatever you want. If you want to test a long system, you know, a long delta system, or a long Vegas system, a short Vegas system, you can create whatever you want. But the one I'm just showing here today is what I would call a long system. But that actually brings up something.
Yeah, I think he was talking about the date, that it was a kind of a bull market if you tested in bear markets as well.
Well, you could argue that it was tested in the. Oh, I see what you're saying. Yeah, a short system. I have done some short systems. They do really well in 2008 and 2009. So anyhow, let me go ahead and generate the base. Let me see. Let me move. Can I move this?
Yeah, while you're moving that, Stephen clarified, he said he was wondering how your SPY example would work in a bear market. I guess you were doing more of a bullish strategy, though.
Yeah, it's that was a long system, so it's a bullish strategy. And can I? Oh, there we go. All right, move that. All right. Okay. Okay. All right. So shall I? Shall we take a few more questions here? Or?
Yeah, we just had a couple pop in. Can you see the chat? Did Tim have
okay,
one
yes,
about?
I see it now.
Okay.
Do you have the SPY underlying results for the following SMA to go long, like your put strategies? SPY underlying result. Well, yeah, I kind of do. Yeah, I have some. I don't. I have several systems that I've tested, but the answer to the question is yes. Can I show it? Probably not today, but I've done a number of them. Is your fractional risk and portfolio running risk based on margin T or reg T? Okay. Well, your fractional risk isn't going to really matter what kind of margin you have. The portfolio running risk, however. See, I trade PM accounts, and so to me, it's that's what I use. But if it, I would say that if you're trading a Reg T, that you're not gonna over leverage yourself in terms of your margin. Unfortunately, you don't get the same kind of leverage ability with Reg T that you do with PM. So that may be a limiting factor. I've been trading a PM account so long now, it's like I forget what Reg T is like. So I'm sorry about, I can't really tell you how this would do in Reg T, but the same principles of limiting your margin exposure is going to still apply. Let me run through the base system here, and first I'll just kind of explain I'm using the underlying table, which is the underlying system for SPY, and what this is a collection of dates where everything above the 200 SMA is a valid date. The volatility table or the volatility system is a collection of the VIX where every time there's a 10% change from the previous day, that becomes a valid date. So this is the system I'm using, very simple. I have another program that I use to generate these systems. I'm not going to show that today because I'm just really trying to focus on showing the risk and money management principles. So the dates that I'm using, I'm simply taking basically my entire data set, except I go down to end of October, so that's almost 7 years. My money management, I'm using a 2% fractional risk, starting out with 100,000, a APR risk of 50%, limiting to one expiration. My model is not interactive in terms of being able to calculate portfolio margin, so I kind of estimated on a per contract basis based on the strike placement, and so it's a little overestimated, but that's okay. My trade parameters, I'm doing 35 to 60 days. That's the window. I'm doing a 5% out of the money strike. I'm doing a 5,000 minimum open interest. And what that does is, as I said before, is it filters out not very liquid strikes. And so that helps. I'm using a stop multiple of 2, a target profit multiple of 0.8, and a break-even multiple of 1. And I'll explain that when I show some charts, what that is. So essentially what I do is it's a kind of a two-step process. The first thing I do is I generate what's called a trade set. And the trade set is a collection of valid trades. So for example, if we look at this trade set here, you'll see these dates along here. This is the close of the SPY, and that's just informational. Now this is the expiration and the strike, and whether it's a call or a put, and then this is the DTE, the days to expiration. Okay, my program, based on the parameters that I set, it chooses these expirations and these strikes, and it's very simple. It's like, for example, you'll look at this date and you'll see that the volatility in the VIX was 10% or greater than the prior day. So that's a green light to say, hey, you can put a trade on this day. So using some very simple queries in SQL Server, it goes out and it executes a stored procedure and says, hey, you can sell, or you can, in this case we're selling, you can sell a 93 put with a September 30th expiration. And just by looking at the date, I can tell that that's a quarterly. But it says that's a valid trade to take. Okay, then on the 1st of September 2009, it says, hey, the volatility was up 10% over the previous day. This is a you can take a trade this day. So it goes out and it says, okay, what fits the parameters? And it says, hey, you can sell a 95 strike with this expiration, which happens to be 46 DTE. So that's what this trade set is. It's a list of dates and expirations and strikes that says this is a set of valid trades that you can take. Now, will you take all of those trades? Not necessarily, because you'll notice here, and let's see here. Okay, how about right here? Notice all of these expirations here. 6/19/2010. Okay, well, I'm not going to take all those trades because that's too high a concentration with the same expiration. So I won't take those trades. I'll just take the first one. And if I change my parameters, I might take the first two. So any event, but you see it came up with 66 valid trades. So once I have a valid trade set, then basically I run the back test. And so the back test, you know, these things don't take very long. Here's the trade log for that back test. And so what you see is the entry date, the expiration, how many days to expiration, the strike, whether it was a call or a put, whether we're buying or selling. There's the entry price, and there's the stop price. Now the stop price, if you recall, we were using a stop multiple of 2. So that's our stop price. So we actually exited the trade on the 8th, and our exit price is 27 cents, and the exit type is PT, profit target. So our actual risk-reward ratio that we made on that trade was 0.85. Now, theoretically, the maximum that we can do is 0.8, because think about it. If you have a stop multiple of 2 and a profit target of 0.8, what that means is, think of it this way, you're risking $1 to make 80 cents. So therefore, your maximum risk-reward ratio, 80 cents divided by 1, is 8.8. So that's the highest you get. The reason it's a little higher is because, well, our target price is somewhat less than 27 cents. Because this is using end-of-day prices, that's because, see, all these trades are made at end of day. So it works to your favor sometimes and works against you others. I can show you what that actual trade looks like. Let's take a look at that trade. This is that trade. So you see, we sold the 93 put, which was 5% on the money, but actually is 5.4% on the money because it obviously it won't necessarily always be spot on 5%. It's going to be sometimes a little more, a little less, but I have a little rounding there to find the nearest one, which happened to be a 29 delta. It was 44 days to expiration. So we sold that for $1.83. Our stop price is 2 times. So our stop price is $3.65. Our profit target is 37 cents. So we sold it. You can see on this left axis is the option price. On the right axis is the SPY. So you can see what happened to the SPY. SPY went up from 98 bucks. Actually got to as high as $1.07 here, dropped back down. But in any event, it came on down. And then here's when it actually exited the trade, 27 cents. So we were in that trade. It started at 44 days to expiration, but we were actually in that trade only about half that time. And this is very, very typical of these trades, is that you can capture 80 to 90% of the credit that you sell within half the time. I've done a lot of testing on this, and it's but when you think about it too, is that you've seen the theoretical decay curves of options, and of course, the further you get out of the money, then the faster the decay is at the beginning, and then it kind of tapers off. Well, this is just really very similar to what you see. So, so in any event, so these are the trades that it took, and you can see we got a lot of black, which is good. And if we look at the trade metrics for that, you see we took 43 trades. We had 35 wins, 8 losses. So we had a win rate of 81%, which is high, and a profit factor of 5.3, which is pretty high. We had a really good expectancy of 0.81. Now this is what's very interesting, is that, see, the average DTE of the trades was 48 days. Now the average days in trade was 21 for a winner and 17 for a loser. Our average risk-reward ratio for a win was 0.83, which is actually a little bit higher than our theoretical 0.8, but that's only because it makes the trades, I'm using end-of-day prices, so it makes the trade at the end of the day. And while you might have a profit target price of whatever it calculates to be, let's say it's 30 cents, and at the end of the day it's 25 cents, well then obviously you're going to have a slightly better risk-reward ratio on that trade. I had maximum of 24 consecutive wins and 4 consecutive losses. Started out with 100,000. We made 58,000. Our return on capital over that period was 58%. Our Sortino ratio was very good, and our annualized return compounded was 8.5 compared to the underlying of 5.7%. So you look at this and you go, hey, that's not too bad. I mean, we're beating the market and we're doing it with less risk. I mean, you're not going to argue with that too much. Okay, but this is only the beginning because well, let me generate another thing here. Well, let me show you one more thing here. I show you a chart here of the portfolio balance variation. This is the change in the portfolio balance for each trade. So everything above the red line is a winning trade. Everything below the red line is a losing trade. So you see we had these wins up here We had I believe that was probably a break-even trade. That was a loss. That was a break-even trade, a break-even trade. These are break-even. That's probably a loss. And then there we have a loss. But you can see you're making money up here. And we have occasional loss here that's greater than what we would normally expect. Normally, we would expect to not have the balance change more than 2%. But in this case, it was 3%. And that, again, is, in fact, we'll just take a look at that trade. What is that trade? Trade number 8. Let's go look at trade number 8. Okay, so this is what happened here. We sold it for $1.62. Our stop multiple was 2, so our stop price is $3.23. Our profit target was 0.8, so there's our profit target price of 32 cents. So we sold it, everything looks good, then all of a sudden, boom. Whatever happened, happened, and at the end of the day, that thing was up at 404. So it blew right through our stop price. So if we look at that trade number 8 here, you see here again, entry $1.62, stop $3.23, but our actual exit was 404. So we blew right through it, and so we had a bigger loss. And that happens. But one of the things that's interesting about this chart is that, you know, a lot of times I've had a number of questions to some people I've shown this to, is that they say, well, trading end of day, you know, what happens if it just blows through your stop price? Well, this is what happens. And as you can see, when you look at it over this is what you see over the course of 7 years. How many times does it really blow through? And the answer to the question is that yes, it can, but it doesn't happen that often that you could actually trade this strategy using end of day and be okay. So any event, the other thing that I wanted to do is in order to show a apples to apples comparison, I have to kind of convert the trade log into a monthly log, and then that way I can generate an equity curve, which is the one that I showed you in the PowerPoint. So again, this is where the underlying was giving you a signal of not making any trades, and then again here and again here. So that's kind of sort of the initial base case system that I wanted to show. Now, now this is where it kind of gets interesting. I'm using a stop multiple of 2, and with that we get a very high win rate, 81%. And so you think, wow, that's pretty good. But this is where it really comes interesting, is because if you actually change your stop multiple, if you take that down to say 1.2, and this is more in the area of what I'm using now, is I used to use a little higher stop multiples, but because of what I'm learning here, I'm actually kind of ratcheting that down a bit. I'm also applying more technical analysis. I'm giving you a very simple example here. But if I use a stop multiple of 2 and I rerun the system, at initial blush, you're going to say, holy cow, that's a lot of red there. I mean, you got a lot of losses. But the bottom line is that while your win rate drops down, check out your annualized return. You've now done 3 times better than the underlying, okay? The win rate, yes, it went from 80+% down to 51%. Profit factor dropped a bit, but look at this. Your average win is $10,800. Your average loss is $5,300. I like that. That's a nice. Those are the kind of numbers you want to see, where your average win is much bigger than your average loss. Look at your risk-reward ratio. Now, keep in mind, again, these are actual risk-reward ratios based on the trade log. that you're making a 4-to-1, 4.14 to 1 for a winner, and you're only losing 2.01 for each loser. So those are nicer ratios. So despite the fact that your win percent has dropped down, you're doing much, much better in terms of, I would much rather trade this system with a tighter stop than the other system with a bigger stop. Now, you do have to have the stomach for it. Here we had 6 maximum consecutive losses and only 5 consecutive wins. But that's okay. I mean, because you look at the risk-reward ratios of your trades, and that's more important to look at there. And your expectancy, 0.55, that's good. And your win rate is really not as important. So that's one example of how you can come up with a much better set of trade parameters. Well, initially you might think, that it's going to be worse. It actually turns out better. Now, let's take that one more step. Let's now actually let's go from 1 position per expiration to 2. So what this means is we're going to be making more trades. And I generally do not do more than 2 per expiration. But I mean, 2 I have found is a reasonable number. Now look, we're actually making some pretty good money here. If we take a look at our trade metrics now, our win rate actually is about the same. It changed a little bit. Profit factor is about the same, and expectancy is about the same. They shouldn't change. But we're doing more trades now. Our average win, 14,000, average loss about 8,000. So now our annualized compound return is 37%. That looks a whole lot better than the underlying of 5.7%. And if we look at look at it on a monthly basis, and we look at our equity curve, you can see we just flat out blow away the buy and hold, or buy and hope, as I like to say. So, and if you also noticed, in all of these scenarios that I ran, I did not change the DTE window or the strike placement or the minimum interest. The only thing I changed was the stop multiple and how many trades per expiration, how many positions per expiration. Those are the only changes that I made. And applying the same money management, same fractional risk at portfolio running risk, you can see how much of an impact that has. So that's kind of it in a nutshell.
Well, you ended up with quite a few questions there, a little flurry at the end, Bill.
Okay. Let's see. Let me go scroll up here. Okay.
Hey, Jim, welcome.
Thanks, Tom.
Let's see. Okay, I think it starts with what was the average trade size in the 2 cases?
Average trade size in what way? Number of contracts?
I think so.
Oh, okay. Well, yeah, obviously the contracts go up. In this last case, here, and of course, since this is compounded, the number of contracts go up. So, for example, in this last case, I was doing an average of 131 contracts. And obviously, too, I mean, I trade the SPX. I don't just trade the SPY. So, depending on the size of your account and what you're doing, you can obviously do this in the SPX as well. So, save on commissions and such. So, yeah, and to see that, but that goes back to that about how if you correctly size the position based on risk, it will automatically keep the risk to your portfolio consistent. So when you go with a tighter stop, it allows you to do more contracts. But of course, the flip side of that is that you're may get stopped out more often because it's a tighter stop. But that can be okay too, as I've shown you, that it's actually better to run a little tighter stop, take the losses, because your risk-reward ratios on your winners is much better than the risk-reward ratio than your losers.
Right. Dave Stewart asked, could you comment on the Sortino ratio versus the Sharpe ratio?
The Sharpe ratio, well, the Sortino, they're very similar, except the Sortino ratio basically measures just the downside deviation, whereas Sharpe ratio measures both upside and downside deviation.
In Sharpe ratios, you actually get punished for outperforming in up markets.
Yeah, I think that as far as I'm concerned, Sharpe ratio doesn't mean too much to me. I'm more concerned about the Sortino ratio because it's the downside risk that we obviously are worried about. Not, I mean, if you're outperforming the market, well, you know, wonderful.
If you know your trade, that's a fine way to end up looking at it. I will tell you that institutional managers look more at the Sharpe ratio because they can end up peeling apart a strategy as well. They'll end up saying, well, if you outperformed it this much on the upside, how do I know you won't outperform that much on the downside and you just got lucky? But if you know your trade and you know that you actually have convexity to the upside, meaning that you can make a lot more money going up than going down, then definitely Sortino is the way to go.
Next question was trades or next day opening price, or are you in the end of day price?
No, everything is done at end of day, and actually you can trade this system using end of day at 20 of 4 or quarter to 4. At that point in time, you know what the prices are, you know what volatility is done. If you have a valid signal at 15 minutes before the close, that works. Now, the other thing, too, that I will say is that what I do is I have standing stop orders in, because when I'm like trading naked puts, I have standing stop orders in. So they get hit intraday. I don't have to wait till the end of the day. So those cases where you have, where it's kind of blown through your stop, in reality, it doesn't happen as bad as that because even in a gap open type of situation, seldom do I see it gapping down so much. But it can happen. I'm not saying it won't. But as I showed you from some of those charts, like if we take a look at the portfolio variation chart again. Now this is for the last one that I ran. You can see that there are a few times, this is over the course of 7 years, you had a handful of cases where if you used end of day prices that you actually did, it blew through your stop price. But you also notice too that it doesn't blow through it like, I mean, it's not it can, but it's not like what you might see after 3 or 4 days of should have exited your stop, but you didn't. And then now a put that you sold for $1.75 is now trading for $5.50 or something.
Next question is, run your SPY back the more expansive data set going back prior to 2008 bear market crash.
Yeah, actually, I just haven't bought the data. I plan to actually buy additional data, but I just haven't bought it.
Fair enough.
I mean, the other thing too is keep in mind, this is just a tool that I built for my own personal use. I mean, that's all this is. So, if I, but I plan to kind of buy some more data. It's just haven't done it yet.
Thomas Quinlan says, when you say tighter stop, are you saying that you're simply honoring stops more consistently?
No. No, when I say tighter stop, I mean tighter stop. If you sell a put for say $2 and your stop multiple is say 2, that means your stop is $4. If your stop multiple is 1.5, that means your stop is $3. So it's not a matter of whether you're honoring it more consistently or not. It's you're tightening it up. If you have a stop multiple of 1.1, you sell a put for $2 and you have a stop multiple of 1.1, that means your stop is $2.20. That's a much tighter stop.
Next question, is there input for slippage to reflect wider bid-ask products like SPX?
Well, I've been using mid prices in my testing, and one of the reasons why I like the SPY is because it's about as liquid as you're going to get, and but that's a good question actually when you start using other index products with wider bid-ask spreads. If that's something that I continue to do some additional analysis and testing, which I probably will, that may be something I'll have to add in.
The simpler the trades to get out, the tighter the slippage will be when the market is falling drastically.
True, which is actually one reason why I like trading naked puts. They're easy to get in and easy to get out.
They are, but when the market is crashing, you better bring your firstborn son to trade in for that put if you want to buy it.
Did the test include commissions is the next question.
No, I didn't include commissions, but if you take a look at, for example, this last run that I did, if you added up all of these contracts here, what do we get here? That was 7,755 contracts. So for me, I pay $1 a contract, so that would be about $15,000. So you could take off $15,000 off that 358, and that would include your commissions. But no, I didn't include it. I mean, maybe I will at some point, but that's again, the purpose of the tool for me was to test risk and management plans, but maybe I'll include it at some point.
How many contracts?
You're trading capital, and I assume that you're generating some trading plans for the accounts you're trading. How close have you found the actual results with your real money trades versus the plans that you've developed with Excel and SQL Server?
To tell you the truth, my entries are much better than these entries because these entries are end of day, and I use a bit more intraday technical analysis, so I can actually carve the turns a little better than the prices here. And then again, I also use intraday stops. I mean, my stops get hit intraday, but that's that usually saves you a bit, because if you have to wait till the end of the day and you see it's already through your stop, why wait? The other thing too is that I'll have to say is that my trading has been an evolutionary process, like all traders, and I used to use much wider stops. It's based on more of my recent work that I'm tightening up my stops now. But again, this system that here I've demonstrated is really kind of a demo system to demonstrate these concepts. I use a bit more technical analysis for my actual accounts.
Bill, would you highlight column O for me for a second?
Column O? Sure.
Yes. And that sum is 775.
Yeah. So it'd be about 15,000 in commissions for me. Roughly 15,000.
Why twice that?
I'm sorry. No, the count. Well, I'm the wrong one here. The count, actually, let me do this here. Well, no, it would be the sum. It would be the sum. So
is that in and out? So it's times 2?
Yeah, times 2. So about 15,000. Yeah, there we go. So, yep.
Okay. I was just wondering because you know that you could get 55 cents a contract through LiveVol. That's about $7,000.
Yeah, that's a lot better. I may be talking to you about that.
You don't have to talk to me. Just click on the banner and you get the discount.
Okay. Let's see. Any other questions here?
Steven says, nice job, Bill. Very thorough. And I agree. I really love those charts that you can pull up for each individual trade. That's very unique.
Oh, yeah, that helps a lot. Oh, actually, that brings up something I was going to say is that well, yeah, it does. And actually, you know, what's nice about it, too, is that you can look and you can see if you have like a really big loss. Like I see this one here, $27,000 loss. That's trade number 58. Okay, you can see what happened there. Oh, now this is also another visual too. I was showing some earlier charts, but with the tighter stop, you see that the stop is now lower. The distance between the entry price and the stop, okay, that's your risk. The distance between your entry price and your profit target, that's your reward. So if you recall when I was showing an earlier one where I had the wider stop, it was much more risk and actually smaller reward. So this kind of shows you. But in this particular case, what happened is that we sold it for $1.50. It moved our direction a little bit, but then boom. And then here's actually where we got stopped out. So we got stopped out at 263, which is well beyond our $1.79. But again, the cases where you have it just blow through, I mean, it can happen, but this is why you have to have your stops. Look, it got up to here, 438. So if you don't have a stop in, even though you using end of day, it's a whole lot better than here. Now, of course, this particular chart, you can look at it and say, yeah, well, look, it ended up coming down. But of course, if you knew that, then you'd be one of the world's best traders.
Stephen asks, is this going to be available to the public at some point? Powerful tool.
You know, I never, when I started doing this, that was not my intent. And I mean, it's not currently my intent, but I don't know. I'll see if there's enough interest there, then it might be something I could consider. I mean, the one thing about this model is that it is pretty easy to use because it's all menu driven here. And there's also, for example, I just cleared it out. See, there's nothing in here. All of the really heavy lifting is done in code and in SQL Server. So, for example, all of the when I generate a trade set, that's actually it's SQL Server using a stored procedure that's doing all of the heavy lifting, and that's what does all the logic to figure out what kind of expirations to do and all that kind of stuff. And likewise, when I run the back test, much of that is done using SQL Server. So it's very compact. So I guess one possible option is to put the data on in the cloud in something like SQL Azure, and then have it accessed through an XLL add-in or something like that. But you know, I mean, I'm getting ahead of myself. But basically, this is a tool I just developed for myself.
And Evelyn was curious, how much did the data cost for MyVolatility?
Let's see. It wasn't actually that expensive. I think it was only a couple $100.
Yeah, I think the end of day
data.
And the
yeah, it's only end of day data.
Yeah, I think, let's see, and Robert says, did you do the programming? I know the answer is yes.
Yes.
Okay, well, I think we're...
Well, too. is I will the slides will be available for people to download. I'll also include a copy of the trade log, and I'll include a couple of the charts too, so that that people can, for example, like the, let me generate the, things like, for example, the portfolio balance variation chart is kind of a nice one to see because, and I can actually save that right now. What's nice about it is that you can see how much is your portfolio changing or growing for each trade, or how much of a hit are you taking. And because after all, it's all about growing your account. I mean, and you want to grow your account without avoiding a big drawdown. I mean, that's the name of the game.
And one thing that directional traders use a lot is that 2% of your portfolio max risk on a trade is pretty standard. But most of us income option traders don't even pay attention to that, which is a mistake.
Yeah, well, I tell you, I used to think a lot in terms of the Greeks and, the adjustments. And I mean, obviously all of that stuff is important. But when I started focusing more on the risk and money management side, I realized that has a more impact on your bottom line than whether you make this adjustment at a 12 delta or a 10 delta, because a good system, a good robust system is going to work under a wide range of scenarios or a wide range of parameters. For example, when I run this system, if I run this system, let's say, 45 days to 75 days at 8% out of the money, it still does good. I can run this system at 25 days to 40 days to expiration and, 2% out of the money, and it does good. I mean, this is what's so crazy is that, the trade that you take, as long as your trade has an edge, and if you're selling premium and the volatility has popped up, there's your edge right there. In fact, that brings up something I wanted to show. If we have just a minute, I'll show you a chart here. I run these charts occasionally. I ran this morning, and what this is the VIX for the closing prices over the last 250 days. And as you can see, this histogram shows you basically it kind of gives you a map to say, hey, if I'm selling volatility around here, you can be darn sure it's going to revert to mean. So if you're a short Vega position, the last thing you want to be doing is selling volatility around here. You want to be selling it more around here and letting it revert to mean. Because if you're short Vega, you want that volatility. You want to benefit from the decrease in volatility. So just by knowing where's a good place to sell volatility and where it's not. Like, for example, you look today, I mean, I wouldn't do any trades until volatility gets up past maybe about 15, 16. Here's, for example, the last 120 days. Been a little more volatile in the last 120 days as opposed to the last 250 days. But again, you don't want to be selling volatility here. And that's your edge. And this is a very, very simple example of using a very simple technical analysis. I mean, it doesn't take much for someone to just look at your Thinkorswim platform and at 3:30 in the afternoon and say, hey, the VIX is up, 11% today. Hey, put on a trade.
Right.
But if you see that the VIX is down, 5%, it's like, well, where's my edge?
Well, I think everybody appreciates your insight and hard work, Bill. It's a really great job. Thank you for coming on.
Sure. I actually do have, here's, I guess, the last, I do have some contact info if people wanted to get in touch with me. Just send me an email. I'll answer any questions, and you can also post questions, I guess, in the forum, so people could see stuff. But anyhow, that's kind of it. Any other final questions?
I think that's it. You're just getting lots of thank yous. Nice job. Very nice job. Thanks. So very well done. And again, tremendous thanks for coming on. It's very, very much appreciated, Bill.
Sure thing. I will email you, Tom, the slide presentation and some trade logs and charts, and that way. In fact, I could even put those trade logs as worksheets, so that if someone wanted to play around with it, they could. I mean, of course, it's static, but they can play around with it.
Right. Really appreciate it.
Okay.
Well, everyone for sticking with us to the end, and we'll see you next week for more webinars. And thanks again, Bill.
Okay, you bet. All right. Y'all take care.
All right.
Thanks, guys.
Bye.
Good night.